He's a young person like us. He's very young. Just looking at the crowd, you can see the age. We have a lot of 20 to 25. We're not going to qualify for CDF budget. CDF, the youth fund. And also we appreciate the mature audience that is here. They are talking about coffee. These guys are not giving up. There's still a chance. The young people are here, welcome. So next speaker. Compounding
kama umepata $5 leo
Okay. I need a class right now. So let's give a round of applause to Mr. Ian Tom.
Atini? Hakuna kiti.
Are we ready for Ian? Are we ready for Ian? Yes. Do you want to learn how to compound?
Yes. And risk management.
Okay, a round of applause for Ian Tom.
Thank you. To me, yo.
Just try to see this.
Okay. Mic check. Wow. Such a lovely crowd. Good afternoon, guys. Good afternoon once again.
Good afternoon.
No risk, no Ferrari. I think that's the theme of this seminar today. Now I'm here to talk about the risk, not the Ferrari. The Ferrari mtapata mkisikia kitu nataka kuambia. So, just to start with, my name is Ian Tom Ondu. I'm a capital markets and securities analyst. I'm equally a financial planning and wealth management professional. But most importantly of all, I am an investor first and a trader second. And I'm about to explain why and equally show you why that's the best way to go about trading. So today, I'll be talking about, just to the first slide, please. So today I'll be talking about trading in quite a different perspective. I want to talk about trading as an asset class, how you're able to measure it as an asset class, how you're able to compare it to other returns in the market, and equally make sure it works for you in the long run. We're going to be speaking the long run game, not the get rich quick game, because it's the long run game that has you achieving your financial objectives or goals. Because I know by the time people get into trading, it's because they want money or they need money. But there's a structure to that. So let me start with a question. How many people in this room know about ROI? It's a very common term in the investment industry. By a show of hands, how many know about ROI? And how many know how to actually calculate ROI? Wow, from only one person knows how to calculate. Awesome. So basically ROI is return on investment. By the time you take your money, your savings, your earnings as a businessman, or even borrow money somewhere, and you put it into use, you're only doing that because you're expecting it to grow. You're expecting it to compound. So today we're going to talk about capital preservation, which is basically making sure that you do not blow your accounts. in simple terms. Juu inauma kupoteza pesa umefanyia kazi, and it's quite discouraging, but that doesn't have to be the way. I think I'll cue you when it's time to go to the next slide. So, the first question you should ask yourself as a trader, beginner, expert, advanced, doesn't really matter, is how do I protect my capital? Because if you do not protect your capital, rather, then you won't even have anything to trade with in the first place. And after you ask yourself that question, what should follow is, what is a realistic measure of profit to expect as I do protect my capital balance? Because most traders in the room ask, nitatengeneza pesa ngapi daily? Nitatengeneza pesa ngapi weekly? But that's the start of a perspective that's going to really tarnish your trading or even discourage you in the long run. Because as we're about to see, trading is something that you measure on a time-bound perspective, but weekly or daily is too short of a time to try and measure your results from. So one thing I have to say is trading is an investment skill before it is a hobby or a hustle, because basically what you're doing is you're dealing with the financial markets. So by the time you get into trading, you need to understand that you're trying to get an investment skill set. And this investment skill set will allow you to create ROI on your capital. Just go back. This is the second slide, right? Awesome. Yeah, we can go to the next one. So I'll be very slow. I'm not in a hurry. I have to make sure all of you actually understand what I have to put across. So I'll take my sweet time, and I'm hoping this will be of value to you. So first question. Say you have a $100 account, and your account drops by 50%. That means if you have $100 and you suffer a 50% loss, that means you now have $50, right? What gain do you need to get back to zero? Who can answer that? To get back to break even, or to get back to 100 where you were. You have an $100 account, you have suffered a $50 loss, you want to get back to $100. What's the percentage gain? Yes, there's someone over there who wants to speak.
$100%.
Anyone with a different answer?
$75.
Any different answer between 100 and 75?
$50. 150.
Mmeshasema zote. Sasa ni gani? Interesting. The first person said $100. DJ, click on $100. Oh, on 100% rather. The person who said $100 is correct. 100% rather. Because when you lose 50% of your account, your initial balance drops from $100 to $50. To make $50 on $50, you have to double your money, right? So that means you have to double $50 to get back to break even. And I'll follow up on this point later. Next slide. So as you can see, protecting capital should be your first mandate. And protecting capital is basically risk management, because that enables you to stay in the game long enough for you to compound, for you to even make extra income on your deposits. I'll call your deposits capital, so that you actually get the weight of the situation. Profit is a byproduct of healthy risk management protocols. Master this principle and you stop trading like a gambler. You start building like an architect. The wealthiest traders in the world did not find a better entry. They found a better relationship to risk. They found a better relationship to risk and they accepted it. Next slide. So if trading is an asset class, then you are the fund manager. Actually, I don't like being called a Forex trader. If you call me a Forex trader, nitakublock. Because it's better to call it electronic trading. I love being called a portfolio manager or an electronic trader because Forex is quite a narrow field, as you've seen. There are a lot of asset classes to trade. And the concept of electronic trading is a concept you can use throughout these asset classes as long as they have candlesticks and they move, they have volatility. The same principles you apply in Forex, you can apply in commodities, energy, you name it, ETFs, stocks. So by calling yourself a Forex trader, you're actually limiting your ability to access other markets. So as a portfolio manager, there's a question I want to read here. When you buy a treasury bill, you ask yourself one question. I believe people know what a treasury bill is, a bond, a stocks, these financial assets that are available in the Kenyan market. So you see, when you buy a treasury bill, you ask yourself one question. What is the yield? When most people trade, they ask a different question. How much can I make? Which is not a bad question. The only limiting part is, how much can I make today? Or how much can I make this week? And then you want to actually use that as a measure of your success in trading. That is the risky question to ask. But if you ask yourself, how much can I make monthly? Then the ballpark changes. Even your perspective changes. The moment you start asking the investor question of your trading, what is my sustainable monthly yield on risk capital? Everything changes. From your position size, the leverage you use, your patience, your results, they're all basically a byproduct of how you think about the markets. How you think about the markets determines how you engage with the markets, and ultimately it determines what strategy you employ. So in Kenya, I want us to make a comparison of what every shilling in this country can earn per year. Not even per month, not per quarter, not per day, per year. Because as I've said, trading is more or less you engaging with the financial markets. If you're engaging with the financial markets, a good yardstick to compare to would be financial assets, right? Because you could have taken that money and put it in bonds. You could have taken that money and invested in stocks. You could have taken that money and put it in an MMF. For the older crowd, I know you understand me better maybe than the younger crowd. So say you have your 100,000 Kenya shillings and you put it in a bank savings account. How much is that going to garner you? DJ, I'd love for you to hover over the bar charts so that they see from the start. The bar charts, just the page we were in. Yeah, so hover over the bar charts. Yeah, now from the start, bank savings account. So these are average figures because they usually vary from bank to bank or from T-bills if it's 91 to 87 or 364, MMF. So in the bank, you'd see you get around 3.5% per year on your 100,000. For this presentation, I'll use 100,000 as the baseline so that you actually get to understand. That means you'll put your money in a bank account, wait for 364 days or a year, earn only 3.5% per year. That's what, 3,500. Who's willing to earn 3,500 in 1 year from 100,000? Fadhali ufungue biashara ya smoky. Ndio? 91-day T-bill will earn you around 7.6 average. Money markets, which is a very common instrument in our financial space, would earn you around 9%. The 364 T-bill would earn you around 8.5% per year. SACCO dividends, 11% per year average. You can do your research actually so that you confirm the figures I'm telling you. Infrastructure bond, that's 10-year, 11.3. Infrastructure bond, 13%. Skilled trading, now that is where the ballpark comes. I want to show you how trading is an investment skill that you can use to beat the market performance and equally compound properly in the long run. So if you're a skilled trader and your objective per month, you have 100,000 and your objective per month is 2%, compounding, because in trading we have the ability to compound month after month. If you have 100,000, you make 2%, your balance is 102,000 by end of the first month. When you're looking for the next 2%, you're looking for 2% on 102,000, not the 100,000 that you initially had. That's called compounding, and it's a really good leverage in trading. So if you're only trying to earn 2% a month, that's around how much per year? 26.8% per year. Already you're beating everyone in the market. But still, it's not quite lucrative as most traders want. And I'd equally not really want anyone to earn 2% a month for all this hustle. You can always earn more. If you're earning 5% per month, you're only targeting 5,000 per month. That means that by the end of the year, you're at 79.6% per year. Now, those are where the numbers start to make sense, because you're actually compounding higher and faster than anything or any financial asset or investment product offers. And that means you're in the ballpark of you're actually enjoying way much more than what people who do not have the trading skill can enjoy. And that's where you separate yourself. Next slide. No, the other one. Another question for the crowd. What is 500,000 compounding at 5% per month? Where is it in 5 years? If you have 500,000 and you're trying to figure out where to put that money into use, you can put it in any of the asset classes I talked about, or you might have actually already developed the skill of trading. And once you develop the skill of trading, it's more or less detrimental or even useless to put your money into other financial assets, because it's not going to compound as fast, but you need to know how to trade. So who wants to answer this question? I believe the people who get this right deserve a gift hamper. Right? Like the guy who said 100 can get a gift hamper. Let me see, I need a lady for this one. The men, just put your hands down. Okay, the lady in pink.
The answer is 1.5 million.
1.5. Another answer? I know you'll say all four of them, just like last time. Someone with another answer? Now it can be a lady or a man. There are no hands up. Oh, wow, okay. There.
9.3 million.
9.3 million. Anybody with a different opinion? No, I'm done choosing. Wow. No, the people at the back. There's a gentleman in a white with the white sleeve. I can't even see his face, is it? Yeah.
9.3.
That's the same answer. I need someone with a different answer. Does anyone have a different answer to this question? Just use the guy at the back as well.
So you want to know the actual answer? Is it?
Yeah, of course, from any of the choices here.
625,000.
It's not here. If it's not here, it's wrong. It has to be here. Where actually, the ushers can just choose now.
4 million.
Okay, let me save you the hassle. So 9.34 is the actual amount. If you're compounding at 5% per month in 5 years, I've heard about business people who compound the same way he's compounding his chicken, where he was saying akiuza hiyo nyama ameuza kuli ananunua ingine. That's compounding. So the answer is 9.3 million, yeah? In 5 years, from 500,000, but you have to be a skilled trader to get that 5% per month, right? That's 18.7 times your money. The same 500,000 in a 364-day T-bill, treasury bill, for 5 years will just be at 750,000. The gap is not luck, as it's there. As I said, you have to be a skilled trader. To now you're going to get that 5% per month out of the markets. It is the compounding of a skill month after month without a fatal drawdown. And that portion is very important, without a fatal drawdown. Because we're going to analyze what drawdowns do to accounts and how to escape such traps, so that you do not have to do too much work or trade too much to try and get back to break even or to try and get your capital back. Okay, so over here I have a live demonstration. I call it the compound engine. And I'm sure this is going to blow a lot of your minds. Slide the first data to 100,000. No, just where we were, the cash 500,000, slide it all the way back to 100,000. That's 100,000 starting capital, right? You're looking for 5% per month. 5% is a reasonable place to start with as you're compounding your skill, because sometimes you have to be very realistic with yourself. You can say that you're starting to trade, you've never made that 5% per month, but now you're looking for 20 per month. Who told you it's possible? You have to prove it to yourself first. Say, okay, I've been making 5% per month for the past 3-4 months, yeah? So let me adjust my target. Let me try and do 8. Let me try and do 10. In trading, it's possible to even do 20% per month. I mean, it's just a matter of skill and opportunities. So with 100,000, compounding at 5% per month, in 5 years, you have 1,867,919. Slide the 5% per month to 10%, just to give you perspective. Now that's 16, that's too high. Do you see what compounding does? The other one was 1.8. Right now, if you're able to do 10% per month, where are you at? You're at 30 million in 5 years. Versus 150,366 in treasury bills, or an MMF at 9%. There's no financial skill set, not financial, investment, because finance and investment are more or less sisters but not the same thing. There's no investment skill set that would give you this amount in such a short time. 5 years is a short time. And that's why I want you guys to look at this from a long-term perspective. So I'll make some references back to this slide later. Okay, here we are. So it says you do not need 5%. Even 2% a month beats everything on the Kenya's menu. And it's true, because at 26.8, but Mansa X is almost hitting that, because they did 25% last year. So, well, if you're doing 26%, you'd rather take your money to Mansa X. But we're not here for 2%. We're here for 5% at least, because that's a very achievable goal, even for beginner traders. You can do 5% with a very minimal risk and see your money compound like crazy. It says here, that is 2% monthly compounded, more than double the best government bond, with no ceiling on capital deployed. The world's most celebrated investment firms average 15 to 25% per year. A disciplined 2 to 3% per month puts a skilled trader in elite global company. The point was never the 5%. The point is consistency without catastrophe. Catastrophe is the drawdowns I'm talking about. The emotional trading that tells you to go all in on one specific trade because you think you're very sure it's going to go in your way. So consistency without catastrophe. You guys can implement that line. It will take you a long way. It will save you from a lot of emotional trauma in the market. So here we're discussing the drawdown trap. Losses cost more than gains pay. And I'll be very slow with this because I know it's a concept that if you're not accustomed to, it might actually be a challenge for you to understand. So if you lose 10%, DJ, once again, you'll be hovering around the bar charts as I go. So it's saying if you're down 5% on your portfolio, you just need 5.3% to get back to break even, right? You have 100,000, your first trade didn't go your way, you lost 5%, you lost 5,000, so you have 95,000. From this 95,000, if you make 11% of 95,000, you already have your money back. You haven't blown your account. Your income, which you took maybe from the business or the loan you took, you're able to pay it. And we'll be hovering around and you'll see actually what big drawdowns do to accounts. And that would equally give you a perspective of why you should actually manage your risk effectively. So 10%, let's go to 20. 20% requires 25% in profit. You've lost 20% of 100,000, you're back at 80,000. You need to make 25% of 80,000 to get back to break even. Just as it compounds, 30, 40, let's go to 50. If you're down 50, just like the other question that we answered, if you're down 50%, you need to double your account. So you need 100% of whatever balance you have left. If you're at, that's 60. If you're down 60% from your 100,000 that you deposited wanting to trade and change your life, you're left with 40,000. So out of that 40,000, you need to make 150% just to break even. Today I'm just going to talk about numbers. You're not going to see a chart here because technical analysis, as much as it's important, it can only survive when you have psychological frameworks and risk management protocols that work. It doesn't matter what you're trading. You might be trading Elliott wave, you're trading trend lines, you're trading ICT, SMC. all those things don't matter if you don't really understand this aspect of trading. So, and it goes on and on. So if you're up, if you're down, that's 95 or 90. If you're down 90%, now you need 900% to get back to break even. Where are you going to get 900% from? So every strategy meets a losing streak. There's no way, or there's no strategy in this planet that you'll never meet a losing streak in. And sometimes it's bad. You might even lose 3-4 trades in a row. Not that you're losing one, then making 7. I'm here to tell you the brutal facts about trading. What you do with that information is up to you. Sometimes you have losing streaks, and depending on the risk you put per trade, it sort of determines what your losing streak is going to contribute to your account. And as we said, it's all about staying in the game. If you're not in the game, you're not making money. If you've blown your account, what do you need? You need to go and look for other money to come and deposit. So if you're doing 1% per trade, after 10 straight losses, say you lose 10 trades in a row with 1% risk, you're only down 10%, meaning you had 100,000, now you have 90,000. 90,000 is enough ammunition to get you back to 100 plus. It's easy to deal with that sort of drawdown. If you're risking 2% per trade, that means after 10 straight losses, your account is down to 18.3%. So you need 22.4 to recover. 5%, after 10 losses, you need at least 67% to recover. And it goes all the way. The others are quite exaggerated. What is happening? Okay. So the others are quite exaggerated. And now, this is where equally full margin comes in. So in full margin, you're risking 100% per trade. Mnasema niende ingiane ama ipotee kwani sikuna kesho. So I didn't even put it here because now that is gambling. Why do you want to be a gambler? If you want to be a gambler, you can gamble on sport bets. People need to respect the financial markets and give it the seriousness it needs. So yeah, for 25%, you're down 94.4 in 10 trades, and you need 1,675% to get your money back. And I'm telling you, you will not. Actually, what will happen is you'll be already so discouraged that you do not even care if the remaining balance goes. Honestly, that's what's going to happen. You'll be like, you imeenda. That is exactly what happens if you do not follow risk management protocols. Next slide. So, it's a question, but I'm not going to ask the crowd. Basically, what it's saying is, what do you risk on a single trade? Under 1%, 1 to 2%, 5% or more, or D, I've never calculated it. So as long as you have margin in your account, na ukifinya haisemi not enough money, unaendelea tu kufinya. Si mnajua sauti point, nakwambia hapa pale umefika, sasa you don't have any margin to utilize. And if you're at D, you do not have a risk strategy. You have a hope strategy. And the market charges interest for hope. And the interest is very expensive sometimes. Next slide. So, here we're talking about how mindset shapes your strategy. How you think about the market is going to determine how you interact with it, yeah? So, if you're a conservative trader, that means you're risking around 0.5% to 1%. The truth is, you need more capital to make gains feel meaningful. Because if you have a $20 account and you want to make you want to risk 1% of $20, I'd advise you to start a business instead, because it doesn't make sense. I remember I was here last year, and there was a guy sitting somewhere around this area. Is this thing working? Yeah, there was a guy sitting somewhere around this area, and he stood up with a question on how exactly he can scale his account. Yeah, I was part of the crowd at that time, and the people who are here actually remember that story. He stood up and said, hakuna venye 0.01 itaimnulia Audi. Just 0.01. Even if you're right on that trade, the money you're making is so little, you better invest in another skill set, you know? So capital determines your profile. If you're moderate to, say, the professional zone, 1 to 3% per trade, it's meaningfully compounding on realistic capital with survival streaks. Disciplined traders, this is where institutions live. And I'll tell you a story about institutions later. Personally, I risk 2% per trade. But I didn't start at 2. I started at 1. Proved to myself, no, actually, I started at full margin. You know, some of these things you have to do, paka uone ifanyi. Ukishaanza kuona ifanyi, ndio like, wow, okay. So, what's another way to approach it? And that was over 4 years of trauma. I do 2% for at least the first 3 trades. If I take 3 losses, that means I'm down -6% on my account. I reduce my risk to 1% until I return the money that I've lost. Aggressive or full margin, 10% or full leverage. Spectacular months until one ordinary losing streak is existential. Catastrophe. Remember catastrophe? Now that's catastrophe. Who survives? Statistically, almost no one. This is gambling with the chart open. Well, I know you've seen a lot of Forex traders driving very big cars, and they say they're doing full margin. You can pay them, they mentor you. Maybe there's another way that I do not know about, yeah? But that is exactly what I don't do. So the impatient mindset demands the bottom row. The wealthy mindset accepts the middle because it has done the compounding math you just saw. Remember our compounding math of $100 starting capital, $500, 5% per month, how many years? We'll go back to that. We'll go back to that presentation later. So basically, traders managing billions are not paid to win. They're paid not to lose. If you're here, especially if you're a beginner, you haven't even interacted with the markets enough, and your first question is, how much money can you make a day or a week? That's impossible to measure in the investment landscape. We don't look at things that way. We don't, because it's quite a short time to measure the success rate of your strategy. At least do your monthly, what's it called? Do your monthly evaluation. Risk per position 0.5 to 2%. Basically what institutions do. Drawdown triggers at 5% to 10% drawdown. Position sizes are cut automatically. The deeper the hole, the smaller the shovel. The exact opposite of revenge trading. Revenge trading says, vile market ishanikulia pesa, wacha nionyeshe. So what do? When you're in risk, you actually bump up your position size, knowing that now once I bump it up, hii hapa itarudisha hiyo pesa yote yenye nilikuwa nimepoteza. Alafu hiyo pia inakukula. So you just get depressed. Daily and monthly loss limits, Depends if you're trading daily, because honestly, trading is not about volume, it's about the quality of trades. You can even take 3 trades in a month, and you're way, way on top than what other people are doing. You don't have to take 20 trades. And lastly, there it says targets that sound boring. 3 to 8% in a month is a celebrated quota in an institutional desk. Because compounded, it builds empires, as you've seen. They play decades. Retails play weekend. Matafuta pesa ya weekend. It's like putting your money, trading is not a savings account. It's only in a savings account that you put your money today and you want to take it out tomorrow or when you have an emergency. Say you've bought stocks today, you've bought Nvidia stocks. That is not the place you go to get your emergency needs because you don't give it the time to compound. You don't even give it enough time for it to appreciate and give you capital gains, let alone capital gains, even dividends. So a trading account should be treated as an investment account, not a savings account. That way you'll have a lot of money to play around with in the future, once you actually get your skill right. The market doesn't reward the boldest trader, it rewards the trader who is still here. I've emphasized this point over 4 times, I guess, in different wordings, because you need to understand that blowing an account is not a flex. Blowing an account is like failing in your examinations. So if there are chances of you reducing the number of times you blow an account, you should definitely go for it. And if you want to do full margin, it's okay to do full margin. And there are equally there are full margin strategies that you can employ that might work for you. But just like in school, you can't come from class 2 to form 1. Full margin in trading is like a master's or a PhD in trading. There's no way you haven't understood the aspect of compounding month by month na unakutaka kuingia na kerere ya full margin. The market will definitely punish you. Prove to yourself that you can actually get this 5, 10, 20% per month. Then after that, you're free to do whatever you want. I mean, at the end of the day, it's your money. Whatever you do with it, it's up to you. You take full responsibility of it. You take full responsibility of the results and your actions. Protect the capital, size like an institution, demand a yield, not a jackpot. It has to be measurable. If some of the things that were presented here, SMART, specific, measurable, attainable, realistic, those are what your trading plan and strategies should actually embed. If you're missing that, then you're in for a long ride. And as it says here, demand a yield, not a jackpot. Jackpot barely survives, especially if you're starting out. Let the months stack. Compounding, pole to get more money. Once you have, if you say started with 100, you've already proved to yourself in 3-4 months what exactly that 100 can do, 100,000 that is. If you get another money, you can add on to it so that you actually enjoy the benefits of compounding, because you've already proved to yourself that you won't blow your account. But if you haven't proven to yourself that you won't blow your account, it's going to be a rat race. And then you'll say how trading doesn't work and start casting a bad name to the financial markets, which you should respect. Protecting capital is the first mandate. Compounding is the reward for obeying it, because you need margin to trade. If you exhaust your margin, you cannot trade. Basically, this has been about, oh, I was supposed to show them something. Go back to, no. Go back to the slide where you choose your risk. 1, 5, 10. There, now, next. Take it forward. There, the previous one, there. So here you see I talked about the percentage you risk per trade. As a beginner, start from 1%. Prove to yourself that your win rate is actually good enough for you to scale. I don't do 1%. I've been trading for 7 years, 10 months now. 1% I've left for beginners, unless I'm in critical drawdown and I need to repair that. So these percentages, they translate into something called a risk-reward ratio. The traders who are here actually do understand what I'm talking about. So if they do transform into a risk-reward ratio, what is a risk-reward ratio? I want to show you the possibilities of trading if you invest your time in the skill set. So you can show the trading view charts. So we're basically